Let's bring in Kevin Green, who joins me now for a good look at some of this data. And we've got consumer sentiment hitting the tape. What are you seeing there? Good morning. Happy Friday, Kevin.
Good morning, Sam. Yeah, actually, if you're looking at the numbers, they all came in below the street's expectations. And actually, there's probably something for everybody within this report. If you're looking at the inflation, one-year inflation expectations, which is obviously going to be very key here, that actually was revised lower to 4.7%. Previously, it was sitting at around 4.8%. And consumer sentiment actually came in a little bit lower as well at 55.1. Street was looking for 55.4. And so you are seeing a little bit of a contraction there, still in the positive territory, but once again coming a little bit down. Now what's interesting is I always like to look at the political affiliations of the respondents within this survey. Obviously it's been criticized because of the lopsidedness when it comes to the outlook of the economy, and I always look at the Republican portion to see what the trends are for the president's actual administration and their political affiliation here. And you are actually seeing a move to the downside for Republicans for consumer sentiment. In August it was sitting at a 96.3. In September it's now sitting at 92.4, and also current conditions moved lower for Republicans. In August it was at 87.4, and now it's at 83.7. Same type of trend when you're looking at consumer expectations. Now Democrats did see a little bit more of a bright spot when you're looking at consumer sentiment right now, but overall it's still kind of leveling out. But I think it's better to see the inflation side actually coming down when you're looking at the expectations there, because Jerome Powell and the Fed is a big believer that if consumers believe that inflation is going to go lower, maybe inflation will go lower. It's kind of an odd type of thought here, but that's something that they kind of are mindful of. So overall, decent report. It's a revision. It's not the preliminary report, so that one has a little bit more weight, but you are kind of starting to see a trend here when it comes to the inflation expectations as well as sentiment for the economy.
Yeah, it's really interesting, isn't it, on that sort of inflation debate, while, as you say, some of the expectations have moved lower. I mean, you do have some sort of suggesting, Powell, perhaps, that this could be a one-off price increase, but then you also have the Ken Griffords of the world who are perhaps suggesting that, you know, we're only just seeing half the impact just yet. We haven't really seen the material effect of all the tariffs, perhaps, on inflation. But I'm just wondering, as we recap the week, Kevin, you know, with what we got this morning with the PCE, what we got with GDP, also the jobless claims as well. If you sort of tie it all together in a nice little bow, it almost feels like there was something in there for everyone. I mean, you could have some people sitting there sort of, I suppose, having a difficult time suggesting that, you know, inflation and that sort of genie is in the bottle. I mean, that it's still sticky, but then it didn't look so bad if you look at, you know, some of the growth expectations now and the fact that, you know, it has come in line with expectations as far as that price print.
Yeah, I would agree. I mean, if you're kind of looking at the economic data this week, a lot of it was better than the street's expectations. And unfortunately, you know, bad news is actually good news for equities at this point. And I think it's going to continue to make it a little bit harder for the Fed to cut rates if we still see this trajectory of the economy kind of holding up for now. Labor market maybe not as bad as we saw going into the Fed meeting, as initial claims over the last 2 weeks have come in lower than the street's expectations. And you are seeing some normalization for the states reporting within that report as well. And so I think that's another reason why we saw yields moving a little bit to the upside, equity markets pulling back here a little bit for the most part this week. And then for today, when you're looking at the PCE data, it came in line with the street's expectations. I think the whisper number was for a little bit hotter. That kind of matches with Cleveland Fed was actually looking for a little bit of a hotter print, and that just did not happen, which is another reason why we're seeing the equity markets kind of rally. But inflation's still sticky. The economy, for the most part, in some respects, is still holding up. Consumer spending is still strong when you're looking at personal income as well as expenditures, hotter than the street's expectations. And once again, I don't think that's a really a good recipe for the Fed to aggressively cut rates over the long term, maybe another maintenance cut this year, but I still believe that October probably will still be up in the air, at least for now, until we get more and more data over the next couple of weeks.
Okay, and what do you make of the market reaction off the back of what we got from the PCE data? I mean, it does look like equities recouping some losses. Interesting movement in the 10-year. It didn't seem to budge. It came off a bit. It's ticking higher now. We're at 418. Obvious moves, obviously, in the dollar, given some of the rate-cutting expectations there as well. But what else really stands out to you as far as what we're seeing with regards to the market's response?
Yeah, well, I mean, obviously, initially it was bullish. We are actually seeing a pretty decent pullback right now. Dropped about maybe 15, 20 points over the last 5 minutes or so. So let's see what actually, news may have hit the wire. But I think initially, once again, the whisper number for PCE a little bit hotter. especially when you're looking at core PCE. And actually, if you look at the components, you can kind of make the case for that reason here. Goods prices for PCE came in at 0.1% to the upside. Services 0.3%. You really don't want to see that. Food up 0.5%. Energy up 0.8%. And housing 0.4%. Those are all kind of still pointing to elevated inflation at this point. But once again, the headline number came in lower than the street's expectations. They're good with that, at least for now. And then we have this technical setup as well, coming back to the 20-day moving average. Only got about 8 points away from that for the S&P 500. Seeing a couple of days of selling pressure, a counter trend, or even a dead cat balance is not outside of the norm here in this type of environment. And then I think next week, obviously, we will reset and hopefully try to move a little bit higher. I think the big risk you have next week that everybody has to keep on the radar, quarter end, is another big options event that probably will increase volumes on the volume on the equity front and the options front. Could create also a little bit of rotation as well. So be mindful of that. That's going to be at the end of September, and so that's a big headline risk for next week, in my opinion.
Right. Okay. Keeping an eye on that event. And also, as you mentioned, as you and I were just talking, we have actually seen technology dipping in the red, joining consumer staples this morning. So that is perhaps why we're seeing the NASDAQ just toying with the line right now. Thank you so much, Kevin, for getting us across the data and your insights on the market this morning.